Let's now turn to the advisory. What are the strategies to use when investing for your children? Well, Matthew Ingram is from Northhaven Financial Management joining us now. Matthew, welcome to AusBiz. Good to have you on the show. So, tell us a little more about what you're doing there at Northhaven and perhaps the clients that you're talking to, particularly when you're talking about investing for your children.
Yeah, look, we see a range of clients here at Northhaven. So we are a team of 5 advisors. We all, specialize in different things. The kinds of clients that I see are typically in their 30s, 40s, up into their 50s, often have young kids or teenagers, and are really starting to think about, okay, I'm interested in investing. I want my kids to be interested in investing, to develop some financial literacy. And so they're often asking, what should I do? How should I invest for my kids? Where do I start?
All right, and I guess it doesn't really matter what age they are if you're doing it for them as an investment. But I guess the question is how you do it. Do you do it in the parent's name? Do you do it in their name? Or there are other issues. There are other methods of doing it too, of course.
Yeah, so this is where it starts to get a little bit confusing for mums and dads who are thinking about investing. I've come up with 6 different ways that you can invest for your kids, and there's pros and cons to all of them. And that's where the value of a financial advisor comes in, is rather than spending that time trying to work out which option works best for you, chatting to someone who can walk you through those 6 options, really high level. We can dive into these more, but the most basic way is investing in your own name and planning on having that account transfer to your kids when they reach the age that you want them to receive those funds. Alternatively, you could set up an informal trust. And a lot of the big brokers that people would know, the Comsecs of the world, they have these minor accounts where you can invest for your kids. It's their name on the account as the beneficial owner. But because minors can't actually hold shares in Australia, the legal owner is still the parent. Now, that comes with some tax consequences as well. But then there's investment bonds. A lot of people have heard of investment bonds. They seem to be becoming a little bit more popular. Investment bonds are these products that some people love and some people absolutely hate and think there's no place for them. I certainly think there is a place for them, but it's quite specific. So these things, they're not taxed in your personal name or your kids. They're completely separate. It's a tax-paid entity, and it pays up to 30% tax each year. So what that means is by the time the kids get it, assuming you've held it for 10 years, all the tax has been paid and your kids can just get that money as it is. 4th option would be a formal trust. And, this is more like the family trust that most people would know about. There's a cost to run these things. So you've got to make sure the cost outweighs the benefit outweighs the cost. Finally, 2 more, a little more creative perhaps, is for older parents, and I should be careful when I say that. I mean, parents perhaps in their 40s with young kids who by the time their kids are in their 20s, these parents are likely to be retired. So investing in superannuation is a way of getting concessional tax treatment in the meantime, but then being able to take those funds tax-free later on and transferring them to their kids. And finally is just investing in yourself as a parent. Working on building your wealth is likely to put you in a position later on down the track to be able to help your kids. So 6 options there, all pros and cons, and happy to dive into any of them a bit more.
Well, I mean, I guess also it's a question, Matthew, of perhaps the effectiveness of them, particularly in terms, as you mentioned there, of tax and maybe even the fees involved.
Yeah, absolutely. Yeah, look, they all have different tax consequences. To go back to those first 2 options, if you invest in your own name for your kids, you will pay any dividends at your marginal tax rate. And so, if there is a portfolio that's starting to grow quite substantially, producing some dividends, you might be starting to pay quite a bit of tax on that on your tax return. Now, there is a case where, if you're investing for the long term for kids, it should probably be in growth assets anyway. So likely to not produce a whole lot of income, but you should be mindful of that. But the caveat to that is when the kids reach, say, 18 or 21 or 25, whatever the ages they want to transfer it to them, because at that point you have been the beneficial owner, you have received the income and you own the shares. When you transfer those shares, you're likely to have to pay capital gains tax by transferring it to your kids. So they might see this nice nest egg, and then they might see a lot of it go out to the tax office. So that's where investing in an informal trust, these products that I mentioned before, these minor trust accounts or minor share accounts, you can put a child's tax file number on those in most cases, meaning they will pay tax along the way. And yes, children pay higher tax rates, these punitive tax rates, but it means that when the shares are transferred to them, there's no change in beneficial owner because they've been the owner the whole time. And so what they see is generally what they get until they then decide to sell the shares. But I mean, if they're a uni student at that point and they don't have a lot of income anyway, they won't be paying much tax when they sell down their shares.
Is there the right age in which to transfer this to their own names, be it 18, 21, earlier or later than that, perhaps?
Yeah, I mean, you wouldn't do it earlier, just the inability to hold shares for a minor, but it's different for everyone. I mean, some parents think that, 20, 21 is a good age. I think most 18-year-olds probably think that they're at an age where they deserve a little bit of money and a little bit of help. But I think if most of us think back to when we were 18, we probably realize that we wouldn't have made the best choices with those funds unless we had some good guidance there. So I think transferring, in most cases, parents would be looking at more at 25. I've even seen cases where it's around 30 because by that point, these kids might have started families of their own, be looking at property a little bit more seriously, and those funds are more likely to go to good use. So it's quite an individual decision, and just the ability to actually not have to make a call on when those funds transfer. A lot of parents will just wait it out and see what happens. If they think their kids are ready when they're 21 or their circumstances call for the need for a bit of help, then at least it's there and it's available.
Matthew, do you also consider property in the mix?
Yeah, look, when it comes to investing for kids, the conversation typically is around shares, but with the idea that as these shares grow, this is going to give them a nest egg to get them into property. So the biggest hurdle for young people getting into property is that deposit. And there are some schemes around that, making it easier for young people. But still, even getting a 5% deposit in somewhere like Sydney can be challenging. So with these shares, often the long-term plan is they're not going to be shares forever. They help the kids learn about investing in shares, throughout their teens and feel like they have ownership over something. But the end goal is to probably use these funds to get them into a property or an investment property and go down that path.